Hello, Maverick traders. Welcome out to your FX and crypto midweek. It is June 21st. Corey here with you, and let's get started. So, as we look at this week and what's transpired, we've probably reached a point where we are at that final phase of this rally. I think that's the case, and we'll talk more about it. We've been saying for the past couple of weeks, well, rewind back a little bit further than that. We said for a few months, this market is likely to go higher. It's risk on until we enter into the exhaustion phase. Now, the exhaustion phase is tricky because it's actually where things can go up the most in the quickest period of time. That's because usually in terms of the four stages, you have a consolidation, then you have a big breakout phase, and then you have a continuation where it's kind of buy the dip, and then the trend will get really sort of elevated and extreme, and you'll get that parabolic curve. Well, the only way to get that parabolic curve is to, when you're in this exhaustion phase, is to have kind of that blow off top, that big explosive move. And that's what we've been in. If you're short term, it's more bullish because you get a lot of upside in a very short period of time. But if you have a little bit more intermediate outlook or time period, then you'd expect that, well, we'll give back that frothy move pretty quickly and then kind of consolidate back down here. And I think that's the case. I think we've seen, especially in the NASDAQ, we've certainly seen that exhaustion take place. The S&P has probably finally reached that point as well. And so if that's the case, we should see the final phase of this rally, this parabolic move, should be given back rather quickly. It should be gone almost as quick as it came, within a month or so, that you could give back those gains. And that's a relatively quick decline, where realistically 10% market downturn in a relatively short period of time like that is a big move. And I don't think it's out of the question that we get that, let's call it a 7-8% drop at least in equities. If that's happening, generally, historically, the best correlation is when the S&P goes down sharply, the yen goes up sharply. Well, the yen has somewhat been left for dead because it's just unlike the other countries, right? When we look at the Japanese yen, it's in a situation that is a little bit more severe, I guess, in terms of the deflation that they had been battling, and they haven't seen as much inflation. So Japan is literally out on an island of not having seen as much inflation as the other countries, and that's really kind of odd when you think about where Japan is. This can be an instructive area to go. If you go to the debt clock, let me show you this. Oops, it's on my other screen. Let me pull it over. So here's the debt clock. And the debt clock is sort of instructive in terms of showing how much debt the U.S. has, which is currently at 32 trillion and climbing, how much of a surplus or deficit we have, and we pretty much always operate on a deficit. What's a deficit? Well, when you bring in 4.6 trillion, but that sounds really good, that, oh wow, 4.6, but you spend 6.2 trillion, you run a deficit. And in this case, we're at about a $1.6 trillion deficit and counting and increasing. And why does the deficit keep getting worse and worse? Well, it gets worse and worse because now we have a lot of debt, and we have to finance that debt with more debt, and we have to pay interest on that debt, and now we have to pay a real interest. Now the U.S. government is paying 5+% on its debt. That's a lot more expensive. When you're down at 0% levels, there's no real concern. You can have as much debt as, line me up for debt if I have to pay 0 on it. But now that debt is adjustable. Once it hits maturity, it gets wound into new debt. The U.S. government doesn't just have enough money to pay all these debts. So what happens when certain bonds, a 3-month T-bill hits its maturity? Well, they replace it with a new 3-month T-bill, right? And so as it gets replaced, it's getting replaced at higher and higher interest rates. So it's a negative compounding effect where each of the debts that the U.S. has are going away at low interest rates, like 1%, and the new ones are coming in at much higher interest rates, like 5%. And obviously, just increasing the amount that you have to pay on your debts, 2 and 3 and 4 and 5% and so forth, is quite expensive. And when we look at the world, it's pretty interesting because Japan, like I said, has been worse off than everyone. And everybody knows this, right? The US has debt to GDP at about a 100%. So when you look at GDP, gross domestic product, we have about as much debt as we have total amount of economic activity for the entire year. If you add up all the economic activity, we have as much debt as we get in economic activity. And of course, they can't tax and take all that money away. If you wanted to pay off your debts, you'd have to pay it off with a little bit of this over time, right? To bring it down. And we don't pay it off. It just keeps getting higher and higher, harder and harder to pay off. But look at Japan. It's at 300%. They're running debt at 13 trillion and their economy's only at 4 or 5 trillion. They're running a debt to GDP that's much worse than most anywhere else when you look at this in terms of debt to GDP ratios. The US gets criticized quite a lot, but the US at 96% seems okay when compared to the UK, compared to France, Italy, Canada, Germany's a little bit better, China's a little bit better debt to GDP. The US is not the best of the best, but it's not. I hear a lot of people say things like, "Oh, the that China's going to overtake the US and all these sorts of things." Well, that is just not going to happen. Number one, other countries don't trust China, and nor has China really earned that trust. When they steal intellectual properties and things like that, it just takes away from that trust. So the idea that the U.S. is losing its place as the number one reserve currency, that's not going to happen in an instant. It's going to happen just little bit lower in terms of U.S. domination of the reserve currency status and some of those advantages. It is dwindling a little bit, but we're talking losing, a few percent of that over time and having that go into other assets. So where does Japan stand? Well, you'd look at this and you'd say at 300% debt to GDP, they have so much debt. How do they get out of that? Well, essentially, they have to keep printing more and more money to pay off the debts, right? That's their only option. They can't tax their way to paying off all those debts. They basically have to print more money. And the worse your debt to GDP ratio is, you'd think, well, the more money that has to be printed. And so does it make sense that the Japanese yen always seems to be in this downward trend for the most part, right? Longer term, for many of the last decades, really, the Japanese yen has just been on a path lower. And that's been the case. That has been true. You could kind of say, if you were just making a guess, had you guessed at any point in time, is the Japanese yen going up or down or sideways, you'd have always been best served to say down. And that's pretty much been true for, like I said, many years now. The question, though, is always what happens going forward. In other words, we know that that's been the case in the rearview mirror. Does that become a situation where maybe it's not the case going forward. And so if you look at this from the standpoint of one of the factors that is inflationary is money printing, and they're going to have to print more and more money for this, my argument would be that inflation, which hasn't been as much a factor for Japan, it will become much more of a factor in the years ahead. And so in terms of inflation, if inflation starts to run hotter in Japan than it has, well, essentially they're going to have to raise rates. And that rate differential right now is the big factor. So everyone knows they're going to have to print money. That's no surprise. That should be priced into the markets. But the market doesn't know what the Bank of Japan is going to be doing with rates. And it's my expectation that rates are going to have to elevate in Japan in the coming months ahead. We just saw a new Bank of Japan governor be put in. They didn't change dramatically their policies or anything that way, but I sort of suspect that if rates surprise on the upside, the Japanese yen will finally have a little bit more of a bounce that's more sustainable. So it remains to be seen, of course, whether that can happen. We've actually, oddly, we're up in the Japanese yen if you were to go back a few months. If you were to go back to the end of last year, I want to say it was like October, maybe September, sometime in the fall, we talked about how the yen was a dangerous short at that point, that it looked like it could really accelerate. And it had this big explosive move higher at the end of the year. If you look at what the Japanese yen has done since that time, it's given back a fairly good portion of that to where it's at, where it stands at right this moment. And I think this is a pivotal moment for the Japanese yen. And my call is that the next phase is a push to the upside. This also correlates. I feel like I have a lot of dominoes falling that can push the yen higher. It also correlates with this risk off idea. If the markets truly are in this stage 4 exhaustion, they won't go in a straight line, right? You've seen a couple of days of selling. There will probably be a bounce in here that'll come back up to about 50% of the decline, and then maybe another rush of selling. That should really get the yen off of these lows. Now, if we use the Japanese yen chart and look at correlations and things like that. So here's the yen, the bottoming point last fall. Notice the big volume. That's one of the factors you see when you look at the ETF, FXY. Huge exhaustion low, which we pinpointed. Now, I am surprised. I was not surprised by this big rally. I said, this is a call I made that the yen could really explode higher. It did that. I am surprised that we've sunk back as far as we have. I would not have anticipated that, but that sort of goes along with, I'm not surprised we had this type of correction, ABC style corrections, but I really expected it to bottom right in here a little bit higher than where it is. And this speaks to, again, that the S&P 500, now this is a weekly chart. Each one of these candles is one full week's worth of trading to kind of condense it down. It also correlates with the fact that I thought that the markets would probably top out a little sooner than what they have. They've started to top out in the last week. Well, we don't even know if it's the top quite yet, right? But they have been falling back. They stretched a little further than I would have just sort of guessed at it in terms of the charts and things of that sort. But even still, I think that we should see another wave of buying here. I have been on the idea that this was a pretty significant bottom. And this is the way bottoming out processes work, is oftentimes there's the big recovery and then you give back a good portion and everybody says, oh, here we go again. we're going to go take out those lows, look out below, and then you start to go this way, and it's a true trend reversal, right? A sort of head and shoulders bottom or what have you. Those types of patterns take some time to play out. So that's where I think we're at in the process. And if I'm right about that, the process and the idea here would be that for the next couple of months, we could really see some big bursts higher in the Japanese yen. Now, Fed Chair Powell came out with an important statement just today. He said inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. So even with some of the gains we've seen, and the expectations are still that next month we know CPI is going to take a big drop, that inflation's going to have a big drop because we're losing the July number from last year, and the July number last year was 1.3% monthly inflation. So we're going to see another big drop in inflation next month that will probably get us back to around 3%. But to go from 3 to 2, that's going to be the really, really hard work. And I think inflation does have getting interest rates back down, and the idea that the Fed's going to cut rates later this year, I just do not agree with. I am in the camp of higher for longer. I think the Fed is going to keep rates higher for longer, meaning it's going to be really hard to get inflation back down to 2. It's going to come down to 3 next month. And then I just don't think we're going to be back at that target. Now, at 3%, is that dire? Is that a huge problem? No, 3% inflation is not something that the markets can't handle, but it does leave the Fed with interest rates up and higher for a longer period of time. And I just think the market has it wrong. The market pricing in rate cuts later this year does not make sense to me whatsoever. I am fully on the camp that that is not where we're headed. And the only way that we would get there is if there was a pretty big market downturn, which would basically mean that my theory and my outlook is playing out anyway. So maybe I'll cross that bridge of, the Fed could cut rates, but only if I'm right in the immediate term anyway. So I sort of think we're in this camp of higher for longer, that the Fed is underestimating this, and I've compared it to the golfer, right? The Fed screwed up, they hit the ball in the water, now they have to err on the side of hitting it too long to not dump it in the water again, and that's where they're at in inflation. They underestimated it for far too long, now they have to overestimate it. They have to err on the side of overdoing it, not underdoing it, and that's where they're stuck. In the UK, CPI came in hot at 8.7 versus 8.4. Not great there. Could lead to increases in interest rates there further in the UK. And then in Canada, retail sales really beat expectations, 1.1% versus the 0.4% expected. Nothing too earth-shattering on the news side. As we look at the markets this week, S&P and international markets each down. US down 1%, global markets down 2%. Now, the big news story this week, which really was good for crypto, if you've been following, 2 days ago, which set the crypto world ablaze. 2 days ago, it was announced that Fidelity, I don't remember who all was involved in this, by the way. It was Fidelity, Schwab, there's another one. But anyway, they partnered, and they're not going to be a brokerage in the sense of they're not going to hold your funds or do anything that way, but they're creating an exchange. They're creating, essentially, they're kind of becoming a New York Stock Exchange. Now, when you trade stocks and your trade goes through the New York Stock Exchange, that is a public hub basically that processes your orders. But your brokerage is not the New York Stock Exchange. They're just a transactional operation. And what this does for crypto is basically the big companies like the Fidelities of the world getting involved in crypto is very good. Now, on Fidelity's side, it's not a big argument from them that crypto is great and you should invest in it. It's nothing of that sort. For Fidelity, they say, well, if we can become the New York Stock Exchange, we can put some money into this, and it's just a business. It's like buying a call option. They don't have much risk. They're not holding customer funds. They're not at risk of Bitcoin prices going up or down. They're simply going to profit from being the exchange. And it's sort of like being the casino, so to speak. The casino doesn't really take risk because when you come in and bet on the Eagles and somebody else bets on the Broncos and they're playing each other, by being the middleman and processing the transaction, they make a little bit of money in the middle. But your risk is offset by this other person's risk, and they brought you together. They're a central hub. And so these companies getting involved, why is it so good for crypto? Well, because it gets the Binances and these companies that are under investigation. And let's face it, the crypto market is littered with just bad actors and people that are, frankly, criminal, right? They're just fraudsters, and the crypto market has a ton of them. So this is very, very good from the standpoint of bringing in more traditional finance companies that now are going to be in a spot where they can process these transactions. It's going to be more approved in terms of the SEC and all these governing bodies and so forth. It's just a good thing from that standpoint. Gold down 1.4%. We talked about this last week. I said of all the things that really looked pretty good, gold looked the best in terms of a trade to the downside. Maybe I'll jump over and just show you the chart of gold here. If we look at GLD and we go to that daily chart, this is what we talked about, that really the expectation that almost the best trade was for gold to break that support, which it has now done. I'm not sure it's going to go a ton lower, but I mentioned that I really had to change an opinion that I had put out there on Twitter. I'm not a big Twitter guy, but I had tweeted that I had tweeted here that I thought gold would trade quite a bit lower, and it did. And then I tweeted somewhere in here that I got to remove my bearish outlook on gold. I think it's kind of done in the short term. And then it just went sideways for a couple more days. And what did we say? If that's all it has, if all you can do is go sideways at the low of the low base, it's gonna break that support, right? And so I mentioned in class that I really, although I had said I take off my bearish outlook somewhere in here, I had to put that bearish outlook right back on because frankly we were gonna see that drop to the downside in all likelihood. Oil up a little bit on the week. So here's the S&P chart. On Friday, you finally got it. One of the things that you look for in terms of stage fours is big volume. Big volume accompanies key turning points. See the big volume back here at the lows. See the big volume right here at the highs. And so just the same way that you bottomed out on the bigger volume area back here, we're probably topping out on the bigger volume area up here. And notice the curvature, the parabolic curve here in terms of the markets and in terms of the chart. Now, this is the S&P chart. It doesn't even show quite as well as the NASDAQ chart, but the same principles in that I think we've reached that point of exhaustion. So the FX markets, since the equity markets topped, are acting the way they should. We're seeing underperformance in Aussie and Kiwi thus far. We're seeing a little bit of a bounce in some of these defensive areas. And CAD, like we said, was maybe more news related, just as the British pound might have been more news related a little bit. But all in all, if you say that we're going to risk off, some of the best trades for that are usually something like a short Aussie yen trade. Well, if you had shorted Aussie yen, that's moved about almost 2% to the downside. If you shorted Kiwi yen, right, and you played it to the downside, JPY, whoops. If you had shorted this, it's down about half. This is up about half. So it's moved about 1% total to the downside. So 1% drop in Kiwi yen, 2% drop in Aussie yen. Not bad so far this week, and it should have more room to go. Crypto, like we said, this was absolutely news related. And that channel we've been talking about, that it was progressing lower, lower, lower. This news was a game changer. And also, importantly, it was an unknown unknown. And those are critical, right? In the markets, we get known knowns, we get known unknowns. Those are the most common. And then on occasion, we get unknown unknowns. Now, the first part of this, what's the known or unknown? This is just the timing of it. This is the schedule. This is when it's coming out, on what date, and so on. And a lot of these things are already known. If you say, well, when is the CPI? We can look it up, and it will say it's on this date at this time. When is the next Fed meeting? Well, it's on this date at this time, and so on. When is the next election for a president? Well, it's on this date at this time. There's a lot of things that are known, and they're scheduled, and they're planned for. And then sometimes the result of those is already known. We already know the outcome potentially. Well, as you'd expect, a known has very little movement. It is fully and absolutely priced in. Everybody already knows when it's coming out and what the result is. That would be like, some election. Let's say that a president is extremely popular, massively popular, and he's up for re-election, and they kind of have, the other party has somebody going against them, but in reality, every single person and everybody that polls and so on, it's just overwhelmingly in the president's favor, right, to win election in the second term. And all the polls show that he's just going to destroy, and that he's leading in every state and so on. Well, there's nothing there. They still have to go through the election process, and there's still a date and time, but we already know the outcome. So that's fully priced in to the asset. There are other times that something can be a known unknown, and these are very, very common. For example, a company reporting earnings. Well, we know the date and the time that's going to report, but we don't know how much they're going to report in revenue and earnings and growth and so on. We get guesstimates from analysts, but we don't know truly. We know when CPI is coming out, but we don't know for sure if CPI is going to come in at 4.1%, 4%, 3.9%. We don't have the answer yet. That's what is coming. But because we know the date and the time and all of those things, these can be mostly priced in, because the market is very, very smart. Now, on occasion, the unknown is truly a huge surprise and way different than the market was expecting. And what do you think happens there? Well, a bigger reaction, because this is way different than everybody expected. But most things are not that way. Take this last Fed meeting that we just went through. It was a known unknown. We knew that last Wednesday, the Fed was going to announce interest rates, and we pretty much knew the Fed wasn't going to change rates, right? So we knew this with certainty. We mostly knew this. There was a little bit of unknown, what kind of guidance will they give? But even that we pretty much knew. We knew that the Fed was going to say they're still battling inflation. They're going to make sure they get it under control. Interest rates are not done by, by a large certainty, so on and so forth. There's still going to be some of those factors in play. So most of it is known, and so mostly priced in. The unknown unknowns, these are the big ones. These are not at all priced in. And that's what happened to crypto this week. The markets were not aware that Fidelity and these companies were putting together this thing. This was not something that was public information, that they didn't know the date and time of the announcement. They didn't know all of the different details, what would be involved and what would be included, and so on and so forth. And so now you truly have something that's not priced in at all. And in this case, it's something that's seen as very, very good for crypto markets, because now it creates some stability, it creates a better exchange, a better opportunity for buyers and sellers, et cetera, right? More liquidity, so on and so forth. And you start checking the boxes of, well, it's good for Bitcoin for this reason, this, this. And it wasn't priced in. You see huge reactions in these markets, and I would argue there can be more still, because it just wasn't priced in. It probably doesn't get all priced in one day or 2 days. It probably needs a few weeks or whatever to get priced in. So depending on how big the news is. Now, I don't know if it's such a game changer that it's going to put Bitcoin back to 50,000 or anything, but I'm just saying it certainly was not priced in. It's a true unknown unknown. And these are the ones that you want to, when news comes out, you have to ask yourself which category it's in. Most of the time, you're going to check this one. You're going to say, oh, another known unknown. Okay, probably mostly priced in. Was there any major, news that was way different than the market was expecting? Probably not. If there was, maybe there's a little more follow through, but these are the ones where when an unknown unknown hits, and they can come at any point in time because we don't know the date and the time, and they can move markets. Well, this one was specific to the crypto markets. When those hit, expect bigger price moves and bigger reactions accordingly. So when you look at the equity markets, we have to grade it out as good given the charts, right? You're above the 20, above the 50, upward sloping. But can there be so good it's bad? And that's basically what I'm arguing, is that I think the trump card to this is we went from a more stable market to a more of an exhaustive market, and now we got to give back that frothy upside move. We're going to give that back rather quickly and come back into this area. So remains to be seen if that's going to be the case, but that's where I think the markets are moving towards. If we look at the crypto markets, I don't have it on this. I should probably just go live, but you had this big channel that it had been intact, and it has broken out of that channel aggressively. So maybe we'll just jump over and look at crypto here really quick. If you look at crypto or Bitcoin, maybe we'll just use Bitcoin itself. Here's that big channel that it's been in. Notice the lower highs that we talked about over and over again, the lower lows. See how last week we kept going down, and then just at the middle of last week, kind of the Fed meeting, or the prior weeks, I should say, down. Last week, we started to move up. 2 days ago, broke out of the channel. Well, this was literally that news, the Fidelity and everything that happened yesterday, and we took off to the upside. We've now accelerated quite dramatically. We've gone from 27,000 on the breakout to 30,000 in a straight shot. This is very good for the looks of crypto markets generally, because now you can say, well, we've gone through somewhat of a trend reversal, a stage 2 breakout. What normally happens after you break out to the upside? You buy the dips and you go a little higher coming up. So there might be a little more of this upside coming. So just from a charting perspective, pretty impressive breakout. If we go back to the crypto markets generally, you can still see a similar type of channeling pattern that it had been in, and the acceleration up and through that resistance zone. So pretty good price action there, giving crypto markets a real buying chance and a real buying opportunity that it hasn't had in some time. Um, I would have hoped, frankly, if you were looking to buy, I don't think I would chase it up here by any means, but I would have hoped that maybe it would initially kind of surge and then give just a 1 or 2 day pullback or something like that, and then you could have bought that up where it spiked and then it spiked again if you didn't get in pretty quick on the initial spike. And I can understand if you didn't buy that spike, even with it being an unknown, you're kind of breaking higher into a lot of overhead resistance and supply. So I personally knew it was good for crypto, knew it was a bit of a game changer. I've been trying to look at it as a buy the dip opportunity, which has left me out a bit in terms of that upside move. So I can't say I capture that in any way, shape, or form, but that's the setup, and that's what I think is happening in that market. Thursday for the rest of this week, so we've got the SNB. If you're trading the Swiss franc, be aware, expected to raise rates by 25 basis points. Then in the UK, I do think a rate hike is most definitely coming out of the Bank of England there. You can see expectations from 4.5 to 4.75. Again, inflation ran hot at 8.7%. They have an inflation issue. They have growth issues as well, but I think there's going to be rate hikes coming still in those international markets. Fed Chair Powell also testifies Thursday morning. And then on Friday, a whole lot of PMI data out of Europe and the US. We get the services and the manufacturing numbers for everywhere, for France, for Germany, for the US, etc. So that's our schedule this week. And if you're trading British pound, sterling, I think that rate hike's coming for sure. Well, I can't say for sure. I think that rate hike is coming, and there might be even some more rate hikes behind it. So they're still in that mode of trying to play catch up here a little bit. Let's jump over and look at a few other charts before we wrap up. I wanted to take a look at our currency baskets here. So here's the US dollar, and the US dollar has been all over the board. I mean, look at this mess of a chart. So every time you've come back to the low end of the range, you have bounced previously. You come back up to the top end of the range and you fail. So here we kind of came in this downtrend and then whoop, right back up, immediately turn, and it certainly looks like we're heading down towards the low end of the range again. So if I was just looking at this as a charting perspective, it looks like, well, probably go back down here. But let me just say, it's just messy. It's just choppy. We're in some sort of big, huge consolidation. So this is not a chart that I really want to stick my neck out too much and trade. If I look at the Japanese yen, I talked about it, that this is not something that has the technicals to be a buy, but it does have some of the characteristics of, really looks like the opposite of the equity markets, doesn't it? Look at where we bottomed. It's exactly the spot where equities topped 3 days ago. The equity markets have pulled down for 3 days. Yes, or the Japanese yen has bounced for the past 3 days. So that's the good news. The good news is it's trading opposite to equities. That makes it an easier buy later on if equities are starting to really turn to the downside. This should be flourishing to the upside. And if you're gonna buy, you're in buy the dip mode. Don't chase the big rallies and don't try to buy too much momentum up. Try to get in at better levels on little seemingly insignificant pullbacks, but that give you a better price. Euro breaking out and above the prior swing highs, so Euro having a nice turn over the past week. Swiss franc, again, they have an announcement coming out overnight, so this has also been in a consolidation. You can see the 20 and 50 are literally right there on top of each other and sideways. British pound anticipating rate hikes. British pound has been zooming to the upside. Where do we go from here? Well, I sort of look at this as similar to the S&P chart, and so I think it's trading a little more like a risk on. That would be my only thought as to why I would lean more on it going lower. CAD continues to perform relatively well versus the Aussie and the Kiwi. Nice upside move. I've liked CAD, and I've mentioned this. I've liked CAD probably for the wrong reasons. I've liked CAD because I thought that it would be helped by some of its exposure to metals and mining, and that's been true of late. Even energy prices have been bouncing and a little bit over the past short term, but that's probably less of the story than just some of the other factors that have been driving it higher. Aussie and Kiwi, like we said, kind of pulling back sharply here. And if you were inclined to look at Aussie as a trade, I think you've got to back this chart out a bit. Whoops. I wanted to back it out this way and just extend our trend line out a little further. If you look at this really long term, look at what Aussie ran into. Just right up around that downtrend line. Should you, from a downtrend, go immediately up and accelerate through? No. If it's going to accelerate through, it'll have to back up, consolidate, and then break through later on. It won't just do it in one straight shot. You don't go from lows to up to the trend line and then through the trend line all in one shot unless you've cured cancer or something. So this is just not going to be able to do that, and sure enough, it's kind of getting derailed right where it should. The question now becomes, where does Aussie go? Is it the continuation of the big trend? Because the big channel is still lower. And that's what I would anticipate, is that Aussie has just recovered back up to the downtrend line. I don't think we're going up and out. I think we're going right back down. I would be more negative. Looking at Kiwi, again, really long-term viewpoint, but you can see the similarities in that don't get sucked up into the euphoria when they start to advance. A lot of those advances are nothing more than maybe moves up to the upper end of the channel, but those channels ultimately push it back down. So you'd need something of an unknown. You'd need something of a game changer type of moment for Aussie or Kiwi. And I just don't know what that would be right off the bat. And I don't know that I see anything out there that's going to greatly improve those economies and currencies enough to do that. Good question. If you are buying in crypto, my first instinct would be still to buy Bitcoin, but buy on the dips. That would be where I think you've got opportunity. You can look at all the others as similar. We're breaking out, but you're still going to have to maybe buy the dip. So if Ethereum came back to maybe 1820, you could play it for a bounce. I wouldn't say it's Bitcoin or nothing, but I think you've got to let these maybe cool off for a couple of days and see if you get a setup. Little mild pullback here would do a world of good towards finding an opportunity to buy. Good stuff. Well, I hope you enjoyed the midweek this week. Looking at our schedule for the rest of this week, we will be sending out a recap, and then as always, we'll have the currency trading room over the weekend. Thanks everyone for joining. Have a great rest of your week, and we will see you next week. Same time, same place, my friends. Goodbye, everyone.